Hello everyone. Today we are focusing on the Canadian Standard for Private Enterprises, ASPE 3061, Property, Plant, and Equipment. While public companies use IAS 16, the vast majority of Canadian businesses are private and follow ASPE. I am Suresh Periyasamy, and in this session, we will break down the recognition, measurement, and the unique impairment rules that you need to know for practice and exams. Let's start with the basics. What is PPE? It must be tangible, held for use in your operations, and intended for long-term use. I want to be very clear about income-producing properties, assets like an apartment building held to earn rent. Under IFRS, these are separate from PPE. They fall under IAS 40, investment property, and can be carried at fair value. However, under ASPE, there is no separate standard for investment property. If you look at the definition of PPE in ASPE 3061, it explicitly includes assets held, quote, for rental to others. So the answer is yes. Income-producing properties are in the scope of ASPE 3061. This means you must use the cost model for your rental buildings. You cannot revalue them to market value just because the real estate market went up. Crucially, note the exclusions. ASPE 3061 does not cover biological assets like livestock or crops, or non-renewable natural resources like mines. Recognition is where we see a distinct ASPE term, betterment. When you spend money on an existing asset, is it an expense or an asset? Repair. If you just restore it to how it was, fixing a window, it's an expense. Betterment. If you make it better than it was originally, you capitalize it. To prove it's a betterment, you need to hit one of four criteria: improved capacity, longer life, lower operating costs, or higher quality output. On day one, we record PPE at cost. This includes the invoice price plus everything needed to get it ready: freight, installation, and testing. Don't forget AROs, asset retirement obligations. If you have a legal duty to clean up the site later, you must estimate that cost today and add it to the asset's value. For basket purchases, buying a whole factory of equipment for one price, you allocate the cost based on the relative fair value of the individual items. This slide is the most important differentiator from IFRS. Under ASPE, you generally use the cost model only. You take cost, subtract amortization, and subtract impairment. Unlike IFRS, you cannot revalue assets upwards to fair value. ASPE prioritizes simplicity and historical fact over market fluctuations. Now let's talk about impairment. This is a classic exam trap. ASPE uses a two-step cost recovery model. Step 1. You compare the carrying amount to the undiscounted cash flows. We don't use present value yet. If the raw cash flows cover the cost, you stop. No impairment. Step 2. If the raw cash flows are too low, then you calculate the loss. The loss is carrying amount minus fair value. Also remember, under ASPE, once you write an asset down, you can never reverse it. Amortization or depreciation is the allocation of cost. You must choose a rational method, like straight line or declining balance. Regarding componentization, while IFRS mandates breaking an asset into small parts, ASPE is more relaxed. You only componentize if it's practicable, and the parts have significantly different lives. It's more judgment-based. ASPE 3061 is designed to be simpler than IFRS, but the impairment rules are actually quite specific and unique. To help you master these concepts, I have also prepared a separate practical application guide for students and professionals. This document includes real-world examples on capitalization versus expensing, the two-step impairment test, and how to handle rental properties. Be sure to review it alongside these slides. If you are studying for your CPA Canada exams and need help mastering the differences between ASPE and IFRS, feel free to reach out to me for tutoring. Thank you for watching.